We are up almost 10% from the lows that were set 2 weeks ago on Christmas Eve, just over 2 weeks ago. It's kind of crazy to watch that kind of a move. Do you feel confident saying that the bottom is in?
It's hard to have a lot of confidence when you have markets doing what they're doing over the last month and a half or so. I mean, the confidence is this, that bottoms are built, everybody will tell you something differently, but over time. If the base of earnings is above zero for 2019, then the bottom so-called numbers are in. We'll get a lot more of that information coming out in the next few weeks. You're going to hear a lot of things thrown into the kitchen sink, so the numbers are low enough so you can actually create a beat for the rest of the year. Markets got so low as it relates to the multiple, down close to 14 times earnings. We hadn't seen that number in a long, long time. But sentiment was so poor. Almost every sentiment measure you could look at was at its low, to the point where, is it a bottom on numbers? It's tough to tell, but it's a bottom on sentiment.
Well, let me ask you this. I hadn't really thought about people throwing everything into these numbers and saying, okay, things are going to be really awful, trying to bring numbers down as far as they can so that they can jump over that.
Right.
I mean, that in the short term, if that's what happens, could create a little bit of chaos in the next several weeks.
And on the flip side, it could be that that's what the market was telling us over the last month, that the numbers were going to be poor. It caught a lot of investors by surprise. Oil prices corrected so much, but now look what's happening. The dollar's weaker. Oil prices
are bouncing back up.
Oil prices are bouncing back up, and that has taken out of a lot of the fragility in the market. So now if you're a short-term investor, you have a little bit more comfort. If you're a longer-term investor, the right thing to do when you get these times where the fundamentals don't correct into a recession is to rebalance. And unfortunately, we didn't see a lot of that. We did not see a lot of buying power on the private client side. We saw a lot of nervousness, which to me lends itself to a 2019 that's better than what most people will believe.
Private clients, you mean, were running for the exits? They did not stand firm, or
they got myopic. They basically stepped back and said, I don't know what's going on. I'm very nervous about it.
But it's okay if they didn't sell, right?
It's okay. Absolutely.
All right, let's talk a little bit, Kevin, just about the signals that we're seeing from the bond market, because that's been another cause of huge anxiety for equity investors, too. The signals that the bond market's been sending us haven't been great, but what do you think is going to happen now?
We think it's going to be a pretty good year for the bond market, and this started towards the end of the fourth quarter in the sense that the Fed kind of blinked, in the sense that they took a more dovish tone. If you listen to any of the presidents yesterday, that was the theme, and it probably will be with Powell today. So when you look at an already in place weaker global growth, and you add that to some weaker numbers in the U.S. economy and a dovish Fed, interest rates have a hard time going up as long as inflation remains under control. So we'll monitor this, but we do like the way that that all of the conditions are setting up for in place or lower rates in 2019, especially if the Fed stays padded till likely June this year.
So you don't see a lot of movement from this point? We have seen the 10-year kind of rebound from some of its lowest levels on the yield. But you don't anticipate much more movement? This is going to be kind of steady as she goes?
Yeah, it's going to be, much like the Fed, it's going to be data dependent. But, even after last week's great employment report, we gave up 5 to 7 basis points in tens, and we've driven it down almost every day since then. So I think those lower rate biases in place for this year until we see any kind of inflation. Now, we got some wage inflation out of the employment report. We'll probably wait to see. We'll get CPI tomorrow and PPI on Monday. It's not like we're going to run away with inflation, so it would take another 2 or 3 months of big wage gains for the bond market to think that the trend isn't towards lower yields. So, we made a big move from about October to December, and likely we'll shave another 40 or 50 basis points off the 10 years as the year progresses.
Kev, one of the big narratives for the end of last year was that the corporate bond market is a ticking time bomb, that there's a lot that could really go wrong. Is that true, and what do you think happens this year?
Well, it's been a good, it's like the fuse may have run out on the time bomb, but there was a fear of Fed continuing to raise rates. There was the strength of the dollar, which was hurting emerging markets, and we're worried about the economy being too strong or inflation being too strong. Most of that went away between December and January. And January has been a big issuance month for corporate bonds. Spreads have come back in quite a bit and will likely continue to as long as these conditions are in place. So I see a much better year for the corporate bond market than we saw in 2018, both from an issuance standpoint, a demand standpoint, and a spread tightening. So that just like in equities, there was a great opportunity to take advantage of the wider spreads. Part of that door is closing right now, and we think it's a better year for corporate bonds all year long.